Well, it's an honor to speak to you folks today. And although the world is slipping into a recession, I want you to know there's something out there called oasis stocks that we can invest in. So at the end of this presentation, I'll give you the oasis stocks that are, in my opinion, a silver lining critical path that we can follow and invest confidently. All right, so let's talk about what's causing all this recessionary fear and why everybody's worried about GDP growth. First of all, the International Monetary Fund is painting a picture of stagflation. And these are their worldwide economic forecasts, and you can see they're now negative. And because as inflation goes higher and higher, it just zaps the life out of most economies. Now, I want you to know that inflation's a lot better here in America. Obviously, today we had a horrendous producer price report. It's up 11.2. Yesterday we had back CPI up 9.1. But on the CPI and the PPI, the wholesale inflation index, since March, the core rates, excluding food and energy, continue to fall. And the Fed's favorite inflation indicator, the personal consumption expenditure index, it's only up 4.7% last 12 months. So inflation is fixing itself. The big drop that you're going to see will be in September and October. And that's because energy prices will be peaking then. There's just a lot of worldwide demand during the summer months. But commodities are priced in dollars. So what's happening is we have a strong dollar in America, so it's shoving down all our commodity prices, lumber, copper, steel, everything. But if you live in Europe and you've got a weak currency, because the euro is at parity with the dollar now, you've got more inflation than we have in America. So the inflation problem is a lot worse in countries that have weak currencies. So we're blessed in America to have a strong currency, and we are an oasis. Okay, so the GDP growth is slowing globally. In blue, we have the UK, but obviously they got chaos there in the UK. The gasoline's over $10 a gallon. A lot of people can't pay their utility bills. They didn't stock up enough natural gas. They just shut down a big fertilizer plant because it wasn't cost effective at those natural gas prices. Obviously, they threw Boris Johnson out of office because of Partygate, but I'm sure the inflation didn't help. Then the next strongest country would be the Eurozone, and they're decelerating at a rapid pace now because Russia's cutting off their natural gas. Germany has this huge chemical industry that's going to be really, really hurt. So they got their own issues over there. And then Japan's next to nothing. And then we're doing a little bit better than the rest of the world. So in my opinion, although this chart doesn't show us as the strongest, we are the oasis, and we'll be doing a lot better. Now, the reason we have a strong currency is that our Fed is raising rates while in Japan and Europe, they're not. What's happening in Europe, they've just gotten too old. They got too much debt per capita. And also even today, there's a crisis going on in Italy. Looks like Italy might get a new prime minister or new leadership because their bond yields are spinning out of control. And the European Central Bank has not been able to stop that. So China is not immune from this slowing growth. In fact, they're part of the problem because they have this zero lockdown policy. So when COVID breaks out, they shut everything down. And you might know that Tesla really struggled in the second quarter because their Shanghai plant, which accounts for all of its profits, was severely compromised. But Volkswagen plants were shut down. Apple plants were shut down. They all started to open with skeletal staffs, a lot of them living at the factories outside in tents. But China's part of the problem right now. And that's one of the reasons that oil prices are down is there's perceived to be lack of demand from China. Indonesia will do a lot better. A lot of businesses leaving China, going to the surrounding countries like Indonesia, Malaysia, Thailand, Vietnam, places like that. Okay, so our GDP, this is the annual rate, but it decelerated to a negative 1.6% pace in the first quarter. And what's odd about the first quarter, they said our GDP decline was due to a 7.5% drop in productivity, as well as some export issues. And they're saying we're in a recession this quarter too. Depends on who you talk to. But last I looked, the Atlanta Fed had a -1.2. The weird thing about this recession is earnings are still growing and we're still creating jobs. So it's very, very odd. Okay. If we're ever going to have a soft landing, we're probably in it right now. But yeah, there's a lot of GDP concerns out there. But our real GDP should be okay if we can basically exclude some of the extraordinary stuff like productivity and all that stuff. All right, here's the Atlanta Fed. They're at 1.2 now. You can see the consensus of economists, though, in early June, we're basically 1.6 to about 4.7. And so the Atlanta Fed has an econometric model that responds to all the data. So tomorrow we're going to have retail sales, and that's a big input. So we'll see. All right, let's talk about our inflationary landscape. Obviously, we got high CPI running 9.1. That just came out yesterday. Today we had producer prices running at 11.2. But again, the core rates are much better. So when we look at inflation, we've had all these inflation spikes before, and then things settle back down. And, you know, the Fed usually, when they raise rates to kill inflation, they usually create when they raise rates to kill inflation, they usually trigger a recession. The Fed has been very unsuccessful creating a soft landing. So we'll see if they'll be able to engineer it this time. Now, as far as consumer prices are concerned, compared to the 70s, we're not quite there yet, but we're getting there. I mean, I can make an argument that, depending on what I'm talking about, inflation is running at the fastest pace in 41 years, but a lot of it's energy related. A lot of it's been food related too, but food was pretty well behaved on the last PPI report. It was only up 10%. So it's energy, and now the U.S. is producing as much crude oils as we did back in 2019, and yet demand has dropped. So we're taking all our excess crude oil and exporting it. You might have seen some news shows criticizing the administration for that. But the bottom line is the trade deficit has shrunk dramatically because of our oil and refined energy product exports. You might wonder why the price of the pump are high. One reason is that they did a big clean diesel push, especially in California. And when they make the clean diesel from animal fats and other waste, they just can't make as much as they can when they do it from crude oil. So we're making 400,000 less barrels of diesel a day than we used to, and that's part of the trucking problem and why diesel prices are so high relative to gasoline. All right, so when we look forward, the expectations for the next year are still pretty bad, but next 3 years they're moderate. So as soon as we can kind of prick the bubble of energy inflation, I think we'll be okay. Now, energy stocks are going to have the best earnings for the next 3 quarters, and it looks like the supply and demand might be pretty tight next year. So it'll be easier to defeat the energy inflation in 3 years and over the next year. But the free market economy has done a great job finding extra oil here, especially in the United States where we're energy independent. Okay, now M2 has gone up a lot because M2 is when you look at longer term bank deposits, longer term CDs, things like that. So as yields go higher, people are hoarding more at banks and things, and starting to get higher interest rate payments. So this means there's a lot of cash on the sidelines that pour in the market if and when confidence returns. All right, so the consumers, 70% of our economy here in America, and the inflation's really hurt their confidence. So these charts show that in red, the people that think inflation is going to be up over 5% is falling fast. In blue, we have inflation 5% or less. And then black, we have inflation down to flat. So here's the deal. As soon as the prices of pumps start to decline, as they are in the East Coast and South, it's going to get better. I was out west here recently. I was still shocked that the gas prices haven't fallen much. Depends where you live. And but consumers are definitely changing their behavior. You know, they're going to national parks less, they're traveling less. I'm amazed how much a demand for gasoline dropped as prices went up. So very interesting times we're in. Now, the Eurozone has consumer prices at multi-year highs, and they are so much worse than we are because they have these weak currencies over there. And so when they import stuff, it's they got a currency headwind, and here commodity prices are falling. Over there, they're actually rising a bit because of the weak euro. So let's talk about the US dollar and interest rates. The dollar is amazingly strong, amazingly strong. So, and we're now attracting foreign capital, and that's shoving our treasury yields lower. In fact, since mid-June, treasury bond yields have fallen, and that's one of the reasons we have a yield curve inversion right now. But those falling treasury bond yields are because the core rate inflation is falling. So that's good, and it's going to help the Fed stop raising rates. So again, I expect 75 basis points late July, 75 basis points September, and then that's it. The federal funds rate will be at 3%. They can't raise rates at their November meeting. It's a week before the midterm elections. And if they have to fine tune anything, they can do it at the December meeting. Yeah, we got 2 more rate increases, and then the Fed hits the pause button. So here's the 10-year rates out there. Now the US is 296, but we were at 3.4 in mid-June, so we've come down a lot. But you can see rates around the world are still very, very low, except in America where we've gone higher. So that's why we have such a strong currency. Everybody is more happy to invest in America, get our stronger economic growth, get our stronger currency, and higher interest rates as well. All right, here's the yield curve. So a year ago, we were in yellow. A week ago, we were in blue. A month ago, we were in red. And now we're in green. So you can see that rates, if you go from red to green, rates have backed off a bit, but there's this little funny bump on the short end of the curve. Now, our friends at Bespoke did a great report that shows when the yield curve inverts like this, it's happened 17 times since 1971. And next 3 months, the markets are pretty flat, up only about 27 basis points. Next 6 months are up about 4.64%. And the next 12 months are up over 16%. So I would argue we're bounced along the bottom now. If you want to play it perfectly safe, just get in early October, and then you get a better pop. All right, so the 3-month to the 10-year yield has been falling. It did invert. I know it says it's not inverted yet, but it did invert. So this is a very, very important ratio to follow, because when they invert, it's usually a sign that the market is washed up. And here's the evidence I showed you earlier. What you see here, if we look at the market here for the next 3 months, it's going to be up 27 basis points. 6 months, 4.26%. 1 year, over 16%. So the flat yield curve is often a sign we're at or near the end of the carnage on Wall Street. So what's happening now with inversion is good. All right. So as far as central banks and assets and all that stuff, the European Central Bank's the biggest. The Fed's the second biggest. And then the Bank of Japan and the People's Bank of China are kind of tied. But it's really us and the euro right now. Europe is so screwed. The gal running the European Central Bank is Christine Lagarde. She's a former head of the IMF. She used to deal with Argentina and all their problems and currency devaluations and things. And but they're really in trouble. And if you can't deliver for the people, they get really upset. So Mario Draghi, the former head of the ECB, is now Italian's prime minister. He said he's going to resign. There's a lot of confidence in Italy. The European Central Bank said they start to raise rates, but they're still going to be negative. They're supposed to go from minus 0.5 to minus 0.25 and eventually go to a quarter. They're so far behind the yields and market rates, it's not even funny. So I expect the euro to continue to be weak. All right, so let's look at central bank assets versus the S&P 500. So the S&P 500 index is here in red. Central bank assets are in blue. And you can see when the central banks turn off the money pump, the market tends to go down. So the central banks know what they're doing, especially the Fed. They knew as they raised rates, they'd prick some bubbles out there. They forced a lot of people to deleverage in stocks. And let me just give you an example. So let's just say you lived in Santa Barbara, nice area, and you had a lot of low basis, Amazon, Apple. Well, you could sell your stock if you wanted some money. The problem is you'd have to pay 23.8 federal capital gains and 13.3 state capital gains. So what most people did, they just borrowed on their stock instead of selling it. And last year you could borrow real cheap, like 1.5%. Now you got to pay a lot more, and you pay more after Fed raises rates a couple more times. So there were a lot of margin calls this year. As a tech stock bubble got pricked, triggered these margin calls. The hedge funds were on margin. They forced everybody to deleverage. So the central banks know what they're doing. They're trying to prick any bubbles out there. They're also pricking a lot of real estate bubbles. So fascinating times we're in right now. Okay, let's look at the outlook for sales and earnings. This is the most amazing thing. The analysts are still positive. So there's two types of people on Wall Street. You have your top-down strategists, which you see on CNBC a lot and other financial shows, and they're all negative. These are big corner office people that can foresee the world, and they're negative. But the boots on the ground analysts are positive. So what in the hell is going on? Okay. Well, okay, things are slowing because the year-over-year comparisons are getting more difficult. But we're still positive, and on both sales and earnings. And here's revenue. Look how strong it is. So as it slowed down, yeah, but it's still positive. And of course, inflation helps sales too, because companies get to raise their prices. We saw that with PepsiCo earlier this week. All right, so where do you go in all this uncertainty right now? Well, I want you to know Wall Street's always been climbing a wall of worry. These are all the previous crises we've had in the past, and look at the market has always rallied. So if they're scared on TV, it's a good time to buy. I do want to mention something about the media, though. The media today runs on Google Analytics, which gets more hits the more sensational it is. So Google Analytics rewards extreme views. Doesn't matter whether it's sports, politics, business news, entertainment. They just want extreme news. Because when you do television or any other media out there, you want to get more hits. You want to be replayed. And how you do that? Extreme news. So we live in a world that sensationalizes or demonizes everything. And that's unfortunate. All right, so what we have here is the S&P and all the recessions that we've had in the past. And it looks like we're going to have at least a 2-quarter recession here. But I'll tell you, this is going to be the most mild recession I've seen. Back in 2001, that was the shortest recession we ever saw. Comment was it might have been a week. A very short one. So we'll probably officially have a recession, then we'll rally from here. Okay, I love the any stock that profits from inflation. So I am loaded in agriculture. And before I get to my fertilizer and agriculture stocks, I just want to mention something. You might know that in Europe, they're pushing to use organic fertilizer versus chemical fertilizer. And it really hurts the output. So the farmers in the Netherlands are protesting right now. They can't make money on organic fertilizer. Another place that went to organic fertilizer was Sri Lanka. And it's destroyed their agriculture industry. In fact, the people stormed the presidential palace and their temporary president is now hiding out in the Maldives. So this all has to do with CO2. And our Supreme Court recently said that the Environmental Protection Agency cannot regulate CO2 until Congress mandates it. So the EPA was pushing all this stuff. They've been neutered. The SEC was going to try to get all the companies to do this. That would probably fail. And all the Supreme Court wants is for Congress to do its job. So if everybody wants to regulate CO2, let's pass a bill and that'll be that. Okay. But as you probably know, Congress is dysfunctional. Okay. So this has made the US agriculture industry more efficient than everybody else. The other thing is, of course, all that Ukrainian wheat isn't hitting market, and they have also corn exports. They dominate soybean oil. So people are going to be starving pretty soon in the sub-Sahara, Africa, countries that buy the Ukrainian wheat, they can't get it now. So we are so lucky in America that we are the breadbasket of the world and we're more efficient. And we're so lucky that our leaders have not imposed the organic fertilizer on the entire industry. I mean, I'm sure there's spots out there that do things organically, but not the big agricultural operations. As far as energy is concerned, the U.S. is the Saudi Arabia of natural gas. Our crude oil production is bigger than Saudi Arabia. It's come roaring back here. This time of year, energy is firm. It'll cool off in the fall, especially crude oil. Natural gas used to cool off in the summer months. But we're so busy exporting to Europe, it's high now. Now, there was a little glitch. Freeport-McMoRan had a little problem in its LNG export facility, and that was in mid-June, and so prices fell. And they fixed everything. They wanted to reopen, and the Biden administration didn't let them. So natural gas prices are oscillating right now. But Europe desperately needs our LNG. Because we've been exporting so much LNG, the natural gas prices don't have their normal seasonality. All right, let's talk about some of my best stock ideas. Okay, before I do, this is a very important chart I'm showing you. This is a matrix of what works on Wall Street. And I like to call Wall Street a wash machine market because no matter how you sort stocks, almost nothing's working, almost everything's down. However, there's one oasis, which you can see in green. It's the dividend yield. We've taken the S&P 500 and sliced it into 10 slivers or 10 deciles based on these criteria. And the only criteria that's up are the top 50 stocks in the S&P with the highest dividend yields. Now, I would argue that you might want to have more domestic stocks than multinationals, because a lot of multinationals are actually half the S&P sales are outside of America. So if you so the 3Ms, the Procter & Gamble's, they might have to start warning about currencies. Microsoft's already warned. But earlier this week, we had PepsiCo announce they beat on sales and earnings, and they raised their guidance. And apparently the dollar's not impacting them, even though the European sales were down. So that is your oasis out there. Stocks with the highest dividend yields in the S&P have been the oasis since the market peaked on November 19th of last year. So what we do is we grade stocks on an A, B, C, D, and F basis. An A is a strong buy, a B is a buy, a C is a hold, a D is a dog, and an F is a dog with fleas. These charts I'm showing you are not gross. They are. We take 1.75% a year off. The reason is stocks have spreads. The other reason I'm regulated by the SEC, they don't let us show you gross numbers. So the first thing you should do, if anyone ever shows you a gross number, especially an index, be suspicious, because they can't do that if they're registered with the SEC. They always got to show you returns estimated for sales and commissions. So, but these are my returns deducting 1.75% a year. So the first thing I want you to know is my grader is online free for you. You just go to navellier.com and click on stock grader. It's there. Click on services, stock grader. We also have a dividend grader we're very proud of. But why don't I just show you some of my best stocks now? All right, so we have ABBV, which is a great dividend stock. It's a very safe stock. We have Alco, another agriculture company, ALCO. We have Boise Cascade, BCC. We have ConocoPhillips, COP, and Devon Energy, DVN. Now, all these stocks pay generous dividends. Here's some more. EOG Resources, very dominant in the Permian Basin. Global Ocean Group, which is a marine shipping company. Natural Grocers, okay, even though I was picking on organic fertilizer, Natural Grocers has a niche out there. And then Starbuck Carriers. So these are examples of all A-rated stocks from our database. And these are all oasis stocks. And these are stocks that are posting record sales and earnings. Now, marine shipping rates have peaked. They're coming down, but they're still very elevated. Energy prices have peaked. They're moderating, but they're still going to remain very elevated well into next year. Biden is in Saudi Arabia tomorrow, okay? He'll be asking the Saudis to boost production. We'll see if they do or not. He's also second up to Saudis because they want to redo this U.S.-Israel-Saudi alliance against Iran. So fascinating times we're in, but these are all oasis stocks that you can invest in. All right, it's time for some questions. I've got just a few minutes to take some. So here's a good question. How come, Matt wants to know, how come gold is not doing well? Well, a lot of that's a strong dollar, and a lot of it is there's a lot of confidence that people can put their money in America and get the currency appreciation as well as our higher rates. I think gold does better when there's no confidence in central banks. So if the Fed did something wrong and hurt the dollar, that gold will do well. But I don't mind you having gold. I'd have physical gold, but just hold in case the world ends, okay? All right, here's another good question. The energy stocks have been under pressure since May. Why are you recommending them? Well, I'm recommending them because they're going to have the best earnings for the next 3 quarters. And if you leave the energy sector, you won't have much earnings, if at all. So the other thing is energy stocks have high dividend yields, pretty low P ratios. It is so cheap out there in large cap. I'm barely at 10 times forecasted earnings. Small cap, I'm under 5 times next year's forecasted earnings. So I want you to know that I think energy is a good place to be. But any day, crude oil prices are going down. They'll be soft, but then you'll see they firm up. Yesterday, I was extremely firm. Today, I am soft, just so you know. Okay, and one last question here. What's my favorite semiconductor stock? Well, that would be UMC, United Microelectronics. They make the chips and all the flat screens that are in short supply now. They report monthly sales. Their sales were up 42% last month. So Micron Technology, UMC, they make all the little touch screen stuff. That's why the manufacturing business for vehicles is under strain. They can't get all the UMC chips. All right, folks. Well, that was it. I hope you learned a lot. Please remember to go to navellier.com to use our stock grader. Also, when you go to navellier.com, you'll get a pop-up called sign up for Market Mail. That's weekly commentary from myself and 4 other people. We have Gary, who's an historian, Jason, who's an ex-trader, Jeffries and Kenneth Fitzgerald, talks about all the games on Wall Street, Yvonne Marchev, our international expert, and Brian Perry, our dividend expert. So Market Mail is free. Please sign up for it. Please take advantage of our stock and dividend graders. They're entirely free too. You can also save your portfolios to our websites. So we're here to empower you, and it's been an honor to talk to you today.
Thank you so much for such a rich presentation, Louis. Once again, if anyone wants further resources, please check out Navellier.com. Thank you again, Louis.
Thanks.